Welcome to the Monday edition of the On the Tape podcast. I am Dan Nathan, joined by Liz Young. That would be EY from SoFi. She is the head market strategist over there at SoFi. Liz, welcome.
Thank you. Happy Monday.
Happy Monday. It was a heck of a weekend in New York City, man. 80 degrees, sunny on a Halloween just weekend. I actually saw you all dressed up. You guys are going to have to go deep on the internet to probably find what Liz was dressed up for Halloween, but that was a lot of fun on Saturday. Liz, you and I got a lot to go through. We do not have Guy C. Adami with us, but Guy and Danny had a great conversation with Brent Belote. He is the founder and chief investment officer at Kaler Capital. He is an oil trader. He's been trading oil for decades, and he had a lot to say on the supply-demand dynamics, geopolitical, and what that might mean for the price of crude. And you're really extrapolating to a whole host of other things that we talk about a lot. So stick around for that conversation. Liz, you and I are going to get the folks ready for the trading week because there's a lot going on this week. We have a Fed meeting. We have a Bank of Japan meeting. We got something going on as it relates to refunding. This might be more interesting to you than maybe what the Fed has to say. And then obviously we are still in the throes of S&P 500 earnings, some huge earnings this week. Two that I'm focused on, Apple and Lilly, both on Thursday, and a few other things kind of smattered in there too. So let's get to it here. Let's talk a little bit about Friday's price action because the S&P closed down, I think, 10.5% on the year. This is the biggest peak to trough drawdown that we've had in over a year. And I thought it was interesting because what happened in the market on Friday, tech was trying to get buoyed by Amazon up nearly 7% after, I think what some would say was better than expected earnings and guidance. I thought it was fine, but maybe it was relative to the expectations. I think the stock was down maybe 17% from its recent 52-week highs into the earnings. And I think that had something to do with the reaction. Also, Intel was up nearly 10% on Friday. But notably, banks got destroyed. And I thought there was a headline, that Jamie Dimon is putting in place a selling plan for, I think it was like 1 million shares of stock. Now, granted, he has been buying stock. I don't think he's ever sold stock, okay? So I didn't think this should be the reason. It's not like they're coming to market with a big block or anything like that. It's a selling plan over the course, I think, of 2024, at least starts next year. But that stock ended down 3.5% on the day. That's a huge move for JP Morgan on no fundamental news. Obviously, yields are still a focus. We have the 10-year at 4.9%. Where do you want to start? Because I thought the S&P closing the way it did on Friday was not particularly great, especially in a week where we had a huge merger announcement in the oil patch, right? The second consecutive one. Lot going on. Where do you want to start, Liz?
Well, I think we start with that price action last week and the idea, first of all, that it wasn't just Friday that this happened, but when we blew through 4,200 on the S&P, which everybody expected to be support, we did not bounce off of that support. And then we got into this precarious range below that where we're sort of wondering how much further down will it go. And we teetered on correction. Thursday, I think we closed down 9.8%. So we were just a whisker away. And then Friday, decidedly in correction territory. Now, of course, you're going to hear that sensationalized, dramatized, and as if the sky is falling from some outlets. Or just some people who talk about it. But remember, I would keep this in mind. On average, the peak to trough drawdown every year is about 13 to 14%. So this isn't even an average drawdown yet. It just is in that definition of correction territory. And now we've got 10% between correction and where we would start talking about it being a bear market. So there's a lot that can still happen. And I even as cautious as I am, I don't want people to get overly scared about the fact that we went into correction territory. So what I think is going to happen now is, and it's already happening, if you listen to what people are talking about today, is the debate between, okay, that was enough, this is a buying opportunity, or that was the indication that things have broken down to a level that we still haven't found support. And in the midst of earnings season, earnings season kind of goes by themes each week. So last week we had a certain theme. This week we start to get consumer names. We start to get some of the stuff that's going to tell us where consumers are spending money, how much money they're spending, and where they're voting with their feet, so to speak, and if they're actually showing up at stores. We got McDonald's already before we're recording this today. So it'll be interesting to get a better read on the consumer, I think, by the end of this week. And also, obviously, the Fed, the biggest story That you talked about the refunding thing. We can get more into that. That's probably not a story that's going to get major headlines because most of America isn't necessarily following it, but the Fed will get the headlines.
Well, it could be one of those things that under the hood moves markets, clearly yields, which could move S&P 500. But let's start with McDonald's. McDonald's sold off 18% from its recent highs. I think those were all-time highs to a new 52-week low. It's since bounced. It's up today on better than expected results. And I think this is kind of interesting. So comp store sales were better than expected. They're talking about some pricing power that they have. This is a theme that, we've been covering now for over a year in this inflationary environment. And, like one of the narratives around consumer staples and one of the reasons why they sold off so hard was that they were losing pricing power at this stage of the game here. So McDonald's is kind of demonstrating that they still have a bit. It could be the beneficiary of a little bit of a trade down, I think, on a valuation basis relative to some of its peers after a decline like that when earnings are still intact. It just got cheaper. You know what I'm saying? So talk to me a little bit about this dynamic, because maybe the low-hanging fruit on price increases was kind of clipped, okay, in most of, let's say, earlier this year, that sort of thing. But some brands that might benefit from a trade down might find another leg of that. Does that make some sense to you?
It makes perfect sense to me. And I've been talking about staples for a while. McDonald's technically falls into the discretionary category, but I think we all think of it as more of a staples fast food chain, or if we're going to put it in a category with the things like Chipotle's or the fast casual, McDonald's certainly the lower price in that category. The trade down, I think, is what those types of businesses are going to benefit from. McDonald's is not alone in that category. We've also talked a lot on this podcast, and I want to make sure we distinguish between these two. We've talked a lot about some of the companies that are just consumer products on grocery shelves and raising prices that way and then calling it organic growth, even though it was just really price increases that have happened because of inflation pass through. McDonald's probably doing some of that as well. I believe they mentioned in their earnings call something about strategic price increases. So, and I don't know what that means. I'm not going to speculate about what exactly is going on there, but perhaps that means not across the board. And if you're a consumer and you need lunch and you don't want to spend as much as what you were spending at some of those fast casual spots, I do think that a company like this is going to benefit from that trade down. We're seeing it, though, across the board, not just in food, not just in some of these restaurant chains, things like Dollar General and what was it, Walmart, that has an average consumer now with six-figure income. So consumers are trading down everywhere, and I think that is what is going to benefit a lot of these consumer staples companies. And I would put food and beverage at the top of that list.
When you have a stock like McDonald's sell off this way before the news is even out, you might have an opportunity to start dollar cost averaging. I think we both agreed that on consumer staples. I think the point that you make about discretionary versus staple and how sometimes they actually flow into each other makes some sense in a period like this where there's not a whole heck of a lot of visibility on the consumer. I want to go to a tweet that you put out, I think on Friday, Liz. Monthly personal spending grew 0.7% above the estimate of 0.5%. While income grew 0.3% below estimate of 0.4%. That's the fourth straight month of spending that's greater than income. To this, consumers are either dipping into savings or taking on debt or both. What does this mean to you about this stage of the consumer where they are? We know we're going to get this jobs report on Friday. This would be the October jobs report. This is going to be kind of important if you think about it. Obviously, we have already heard from the Fed and get a sense of where their heads are at about future rate increases, about inflation, about the strength of the jobs market. But this tweet is important to me because you are tracking spending of consumers relative to their savings, and it possibly puts kind of in our head a little bit about where these trends might be going in the not so distant future.
So there's a few things that I would mention about what I do for work. A lot of it is talking about indicators, but I don't make a really concrete conclusion, and I don't get adamant about something unless some of those indicators are confirming themselves. So you might look at one data set and say it's telling us XYZ story, but it has to be confirmed by some other data sets. And this is now beginning to be a theme where you're seeing some of this trend be confirmed. And what I'm talking about is we've got spending still exceeding wage growth, spending exceeding, obviously savings has come down. If you look at the savings rate, it's come way, way down. So if people are spending more than what they're making, it has to come from somewhere, whether they're putting it on credit cards. And that's one of those points that has confirmed. starting at the beginning of this year, end of last year, beginning of this year, you saw credit card balances increase substantially. They sort of plateaued late summer. So people stopped spending on credit cards, but that was after a year of spending furiously on credit cards. So we know that some of that spending and the gap is being made up by taking on debt. The other piece of it is the savings rate has gone down tremendously. So people are not saving as much money. That confirms that as well. So maybe they've dipped into their savings, or at best, they're just spending everything as a dollar comes in, it goes right back out the door, right? And they're not saving anything in excess. Now, the rebuttal or the contradiction I might hear from that is, well, the savings rate is always low and things are good. And that's true. People aren't scared, so they're not saving as much, and the savings rate goes down in normal environments. Those normal environments are not usually what's happening this late in the cycle after this much monetary tightening. So I think that there are now multiple indicators that are confirming that the consumer has slowed down spending at best. At worst, the consumer is getting nervous or has actually started to run out of money in certain income levels. I recognize that higher income levels have probably not run out of money yet, but those lower income levels are likely running out of money or already under a decent amount of pressure. So that was the point of that tweet on Friday. The other thing I would say about Friday, we got PCE data, and we're going to hear from the Fed this week. The Fed watches core PCE, right? That is their metric to watch. If you look at the projections that they just gave us in September, right now core PCE is at 3.7%. They're projecting it to stay there. So the Fed doesn't even expect inflation, the metric that they watch, to come down for the rest of the year. And we've got 2 more months to go. So I would say that that's probably not the trajectory that we want to be on either. Granted, it's not going up in their projections, but obviously we want it to come back down. So if we've got through the end of 2023 a Fed that believes we're not going to see that much more cooling in inflation, that's a Fed that's probably still committed to at least leaving the door open to more hikes and keeping us in this mentality that it may not be over yet.
Yeah, and if we're just going to string all of this together a little bit, I mean, you get to, stagflation. I mean, really, when you think about it, right? So if the Fed is successful in cooling the jobs market, and again, we're going to know more about that on Friday. I think the September number was, 335,000 or something. I think the expectations are 175, 185 or something like that. So a meaningful step down, like month over month here, the unemployment rate expected to stay at 3.8% or something like that. But if we do have the unemployment rate go up, right, and we do have those job openings, go down a little bit, and then we see average hourly wages going further at a time where inflation remains sticky, and then companies like McDonald's are able to raise prices a little bit. That does not bode well, I think, for a consumer where the savings rate is going down. So I want to talk a little bit about this refunding and why this is important. This is a quarterly refunding announcement that comes out, I think, just a few hours before the Fed announcement on rate hikes here. Why is this important to you? You and Guy and Danny have spent a lot of time on the pod talking about Fed issuance here. Okay, so the amount of issuance that they have to do here. Talk to us really quickly about why this is important, why investors should probably keep an eye on this, and what are the potential, I think, for movement in yields. We have a 10-year at 4.9%. You made the point, Guy's made the point, Danny's made the point that, yields, being stuck in and around this level are kind of also helping the Fed out a little bit, at least for now.
That's right. So I think it's no secret to anybody that we run a budget deficit in the United States of America. In order to fund said budget deficit, we have to issue debt to pay for our obligations, which is why we've teetered on the brink of government shutdown a couple times already this year. So that's what we're going to hear about this week. We're going to hear about how much the Treasury needs to issue in order to fund obligations and cover that deficit. Because we know we have a deficit and because it hasn't gotten smaller necessarily, they have to issue some. What's happened over the course of this year, and particularly in the last few months, we've had to increase the amount that they're issuing because they need to cover their expenses. That's happening at a time when yields and the cost of borrowing, not just for consumers, but the cost of borrowing for the government has gone up so much. If they do that, if they have to issue more debt at higher costs, that, number one, increases their own costs, right? Because interest expense goes up as rates are this high, which is it's a feedback loop that just kind of grows on itself. So increases interest expense. Then we have a bigger deficit to cover as months roll on. They need to issue more in order to cover that deficit. However, if you look at some of the action in Treasury auctions over the last few months, we just had a pretty healthy 20-year, but the other auctions have not gone so great. So as we have to continue issuing debt, if there's no appetite, because we know we've lost Japan as a buyer, we've lost the Fed as a buyer, and we're losing some other big international players. If there's not enough appetite for the debt that we're issuing, you've got too much supply, not enough demand, and yields rise further. So it just continues to drive those borrowing costs up. It's almost like a self-fulfilling prophecy of everything that we're worried about. And that's what could happen as the year goes on and as the months go on if we need to continue borrowing. And to wrap that all up, why do we care as investors? Even if the Fed says on Wednesday, we're done. We're done hiking. We're going to actually start easing at some point, maybe before the market. People will celebrate that as a dovish message. But if you've got the bond market tightening on the other side of it, it almost doesn't matter. You still have monetary conditions tightening, and it puts the screws to capital across the economy, no matter what the Fed says. So that's probably the biggest concern that I would have.
And, it's interesting, as we're talking right here, Danny Moses just sent this to me. It was an op-ed by Mohamed El-Arian in Bloomberg, time to hasten Japan's yield curve control exit or risk unsettling instability. Distortions from the BOJ's policy of suppressing yields threaten to spill over into bond markets in the U.S. and elsewhere. I mean, so when you think about that, you just saw we have been losing foreign buyers, right? But, Japan's efforts on yield curve control, how do you see this kind of playing out a little bit in talking about the instability? Because it seems like, we went from 3 years ago where every central bank was tripping over each other to ease, right? And now we have a situation where, some of these longstanding policies, let's say in Japan for decades now, are flying in the face of what we need to do to battle inflation here and to basically raise our interest rates. So it just seems like it's been a very, very frantic few years by these central bankers. And to Guy's point, and again, I am not a central bank basher. I think these folks have a tremendously difficult job. I think they do have their best intentions in mind as it relates to kind of managing crises, and they've definitely taken a forefront as it meant, as far as crises, at least in my career over the last, say, 25 years, and trying to, kind of battle instability in financial markets and obviously maintain some level of stability for the economy. Obviously, they get things wrong, just as almost every investor or every policymaker does. But right now, we do have this situation where some of these policies are really competing with each other in a way that could add some instability if they were to go awry.
Right. Well, I think Japan has shocked people more so than what's happened with the Fed, because Japan had been on this path of we're going to keep the yield curve exactly how we want it. It seemed like it for an eternity, right? And now they're sort of backing off of that because they don't have a handle on the currency. They don't have a handle on some of those inflationary forces. I think it's another drop in the bucket of a country around the globe that has a central bank that isn't exactly sure what's going to happen for the next 6 to 12 months. And we've shifted from proactive to reactive. And now central banks are getting into this reactive state, which is not a good place to be. Usually you get into a reactive state late in the cycle when you have to save stuff, when you have to fix stuff. And it's starting to feel like that's where we are, not just in the US, but around the globe. And I don't think that is the best place to be if you're Jerome Powell or any other central bank. I'm not going to defend central banks here because I'm like you. I'm not a critic of them necessarily. I don't think that they're malicious. They're all pretty bad at predicting what they're going to do. And it's difficult, if not impossible, to predict what they're going to do because a lot of the stuff that they use, the theories that they use, the models that they use are built on economic theories and academic theories of things that have happened in the past or certain theories as they should work in an environment. The data that they use to put into those theories is mostly backward looking. So it's a function of garbage in, garbage out, or stale data giving you a stale response or a stale signal about what you're supposed to do with policy. So it is almost impossible for them to get that right, but it's also an indication and a lesson. Every single time it's a lesson that investors shouldn't put too much stock in what a central bank is predicting that they're going to do with their own policy. You're never going to hear a central bank say, we've modeled in a recession in the next 12 months, and here's how we're going to react to that recession. So if you need to prepare yourself for a drawdown or for a recession, you're going to have to do that on your own and not rely on their commentary.
Yeah, well, I'll just say this. In the last 15 years, and I've said it to Guy and Danny, and probably you too, I mean, I was working in an investment bank in 2007, 2008 that certainly would have gone under if it wasn't for the tremendous, support of the Fed and all the fiscal and the backstopping of some of these organizations. And you can't prove it counterfactual, but I believe that we probably, if numerous other banks had gone under, right, we would have been in a depression. There's no doubt about it. And if you think of the backstopping of some of these big industrial companies and GE, and the list goes on and on and on. And then again, with what happened, during the COVID crisis in the spring of 2020, I mean, we most certainly would have had credit seize up, and we would have had, like something that we would not have been able. It was the epitome of a black swan. So at the end of the day, for them to call inflation transitory, this it's just semantics, in my opinion. You know what I mean? Like, people have been calling for inflationary pressures since basically all of '08 and '09 and 2010 programs. And yeah, it might have been garbage in, garbage out as far as the models in which they were using to measure inflation and its impact on the economy and consumers and balance sheets and the like. But we had a pretty stable period here. And if this is the worst thing that happens is a bunch of volatility after a black swan event as they try to normalize interest rates. And don't forget, I mean, I know you don't forget, in 2017 and 18, what was Jerome Powell trying to do? Normalize interest rates in anticipation of the ability to kind of get easier in the event of the next sort of event. So, at the end of the day, and this is something that Guy, Danny, maybe me and you can have a much larger conversation on, because, again, I don't always find it that productive to weigh on every word that the Fed has to say, because at the end of the day, we get to focus on what the companies are doing and saying. And to me, that's most important for investing in the stock market. But I will tell you, which leads me to the cover of Barron's, and Barron's often gets destroyed for their big proclamations on the cover that they have here. But I thought this weekend was really interesting, Liz. It's time to stop crying about bonds and just buy them instead. Now, I have tried to do that on a few occasions this year via the TLT, the ETF that tracks the 20-year, and that's been wrong, and I've lost money. I've caught a couple little rallies in the TLT, but obviously it's been lower left, upper right for bond yields this year. But I will say that a theme that, when I was asked on CNBC or our pods, how would you invest? This was in 2022 in the throes of that bear market. And I would use that expression Qs and twos. I would say, the QQQ, the NASDAQ 100, averaging into that, and then also doing the same in bonds, whether it be twos or 20s. And I get it. There's a big difference there, but they're both about 5% right now too. So either way, I think that if the NASDAQ 100, if the QQQ were to get to that 20% plus range from its highs, I would be looking once again at the Qs and twos. And I think that is a trade to dollar cost average. And what do you think of, and we don't have to spend too much more time on bonds, let's get to some of these earnings this week. What do you think of, though, at some point, if we were to see the NASDAQ 100 pull back, or we were to see some sort of confirmation that the Fed, at where they are relative to their inflationary targets, and I get it, they're not near that 2%. I do think at some point we're going to see that rejiggered, maybe 2.5%, 3% or so. I think that trade makes sense to get back into the TLT, because if stagflation were to be a theme as we go into 2024, Liz, I think it's going to be hard on equities, but I do think that means that yields are not going to go too much higher in anticipation of the recession that will happen in 2024. And then at some point, the Fed gets easier monetary policy.
So the first thing I would say is I actually don't think the Fed is going to change the inflation target, but I think the way that they probably communicate it, and this is just splitting hairs, but the way that they probably communicate it is saying that the neutral rate is above where they originally expected, and they're going to basically stop lowering rates at a higher neutral rate than what we originally planned on. I will not be surprised to hear that. As far as bonds, full disclosure, last week I added to my 7 to 10 year position, Treasury position, and I added to my short Treasury position, which is a 1 to 3 year ETF. And I also have directly a 6-month T-bill that I've continued to roll for about 9 months or so. So I actually do think that there's decent opportunity in bonds, but this isn't something that those positions, I don't expect them to kick out a ton of capital appreciation in the next 30 days. This is something that I want the interest while I wait. I want the yield while I wait. And I haven't seen yields like this in my career. I don't expect to see them again for a while. Now, if let's say the 10-year was at about 4.95 when I bought my last position or added to that position. If it goes up to 5.25, okay, bummer, but 5.25, if that's the top, I'm okay with losing a little bit in the near term, knowing that over time and more likely in 2024, we're going to see that come down. The only reason that I do the 10-year rather than something longer is because I want the leverage to all of the rhetoric that happens around the 10-year yield and the way that the market reacts to that in real time. And as fear increases, you do see more volatility in the 10-year. And look, I love volatility on the upside if prices are going up. So I want some of that exposure to the chatter, and I want some of the exposure to the volatility that you see in that space. But I do like bonds here. I like treasuries. I don't like corporates. Even investment grade corporates, I don't like. I still think spreads are too tight. They've slowly risen. We've had this quiet rising in spreads, especially in high yield, but I think that they're still ripe for a bit of a blowout, particularly on that high yield side. But I would be careful in the corporate environment. I think there are a lot of corporations out there that took out these bonds or that started borrowing when rates were very, very low. And generally, I think I mentioned this last week on the pod, the average duration, if you just look at a bond ETF that covers corporates, the average duration is probably somewhere between 5 and 7 years. So think about where rates were in the last 5 years or so. Obviously, many of those rates much lower than they are today. So I'd be very careful in the corporate space.
Yeah, no doubt about that. Okay, and you have been mentioning that the LQD, the ETF that tracks, it's the iShares iBox liquid corporate bond ETF. I mean, it is very near its 52-week lows and well off those recent highs of earlier this year. It's trading around 99, 100-ish or so. I think it topped 112 earlier in the year. Let's look at Apple, which actually trades a lot like a bond here. You think about that huge cash position and their ability to kind of make a yield on that. And that was something that people, I thought, essentially, yeah, they buy back billions and billions of dollars of their stock every quarter. But, what they were returning on that cash was something that I think some investors had placed them in the penalty box a little bit. Guys made this point on many occasions that years ago when the stock, when the company was growing the way a growth company should be, it had a value, a value sort of multiple on it. Now, when it's expected to grow high single digits earnings and sales, trading about 25 times. It was kind of getting a bit of a Staples valuation here. And so when I think about Apple reporting Thursday after the close, the implied move in the options market is about 3.75% in either direction. The stock is down 15% from its all-time highs made in July. A lot of the chatter is in and around China and how the iPhone 15 is expected to do. I think some of the data, year over year in that October month when they released the 14 a year ago versus now, down about 6% or so. I think in the quarter, some of the expectations that, sales could be down 4%. They have a Mac event tonight, which is really interesting, Liz. It's a prime time. It's 5 o'clock, Pacific time, 8 Eastern. They don't usually do that. Also this morning, when I was looking on the Wall Street Journal and the New York Times and the business section, I saw advertisements for that event. Tim Cook was recently in China at a gaming event hosted by Tencent. We know that, China has been very difficult spot right now for Tesla. They've talked about retooling of some plants. One of the reasons why I think it has to do with competition. And competition is the story for the iPhone 15 in China. Huawei has some great phones. A lot of these other local manufacturers have some great phones that have caught a lot of steam at a time where the government is banning government workers from having iPhones. So again, lots going on there, but this is one as basically Apple has looked to move manufacturing out of China, like places like Vietnam and India. To me, does Apple become less important to the Chinese, both from a consumer standpoint, from a manufacturing standpoint? Does they run the risk of supply chain disruptions there as the Chinese basically de-emphasize maybe Apple after 2 decades of emphasizing them from a jobs provider? I think that's really interesting. So when the company reports on Thursday after the close, this is one that obviously I think has multiple implications outside the company itself. Thoughts on the importance of Apple, not specifically on the fundamentals of the company, Liz? A stock the largest equity down 15% into the print, where a lot of this stuff is known now. At least the fears are known. Do you think it runs the risk of having the sort of response that we had maybe out of an Amazon or an Intel if the numbers are not as bad as expected, or at least the guidance or the visibility doesn't appear as bad as some investors expect?
I think Apple is a company where there's a very big difference between the consumer sentiment around it and the investor sentiment around it. And I do actually think it's pretty interesting that they're doing a primetime event. I didn't realize that that was the case. Uh, I wish I could call somebody there and ask them exactly why that is. There could be, I think that there's probably a couple possibilities. You've got, first of all, you're just trying to drum up enthusiasm about a product and get in front of the people who are actually going to buy it. So I think that makes sense. But since it's just a Mac event, right? It's not an iPhone event, an interesting approach. But it also could be a situation where you want to drum up enthusiasm about the stock and you want to get in front of the retail audience. And the retail investor is such a powerful force, and you want some of that word of mouth. You want people to have chatter about it. So an interesting approach for sure. I think Apple is also a stock that I would put in the really important to the market sentiment column, where if Apple goes a certain direction, people start to look around and say, oh, wait, something's wrong. If Apple's going down, other stuff is probably going to go down too. And you start to have this guilty by association, whether it's in the Magnificent Seven or in just some of those big tech names, people just worrying about stocks moving in tandem in a different direction. And as much as the Magnificent Seven has benefited investors who've been present in them this year, I think it can go the other direction as well if you've got a handful of them moving down pretty quickly, which at this current moment we do. So it does dent sentiment. I think Apple is a very influential name, not just for consumers, but also for investors. And we know, obviously, how much of an impact it has because of all the ETFs that it's a part of. So as investor sentiment changes, whether it has anything to do with Apple at all, Apple suffers or benefits just by design.
Yeah, well, listen, I mean, not to put too fine a point on this as far as the Magnificent Seven. I mean, Tesla got them kicked off, and I think that was fairly disappointing, the results and their guidance, and the stock sold off tremendously. Microsoft put up good results, but it ultimately ended up giving back a lot of those gains. Alphabet got absolutely destroyed. Amazon bounced. Let's see if it could kind of hold that. We don't get NVIDIA for, a few more weeks or so. So when I think about what's going on here, and I'm looking at just like a little table of the sector ETFs here, I see, communication services, that's a bunch of internet technology, is a bunch of hardware. Those are both up about 30% of the year. Consumer discretionary, which is basically Tesla and Amazon, also up about 15% on the year. But after that, industrials down 2% on the year, energy down 3% on the year, basic materials down 3.5%, financial services, the XLF down 8%, healthcare down nearly 10%, staples down 10%, real estate down 12%, utilities have gotten destroyed, down 18%. The stock market is not working unless you are a mega cap tech stock. And I think that's the story. But this is another one that I want to put, and this is the last thing we'll hit here, because I think this is really important. On Thursday, Eli Lilly and Novo Nordisk, okay, they both report earnings. Combined, they have $1 trillion in market cap. The stocks are up over 100% from their 52-week lows, up 40 or 50% or so, I think, each one of them on the year, okay? Eli Lilly trades about 45 times next year's expected earnings, okay? This is all in these weight loss drugs, these GLP-1s. The two of them are benefiting from this. The way the stocks react to their earnings and the guidance that they give, I think this could be as important as Apple. Why? We've seen lots of investors move into these names, especially a lot of growth tech investors, okay? Rarely do we see pharma companies trade at these sorts of multiples. So, I think some investors are looking at these and thinking of it as a massive mega trend. And I get it, okay? Personally, beneficiary of these drugs, okay? But how they react to what is likely to be good results and guidance might really give us a good sense of how the rest of the market or investors are positioning for the rest of the year. Because if AI and GLP-1s, two of the best stories in the stock market and two of the only things that are working right now to this point, if they can't find incremental buyers on good news, then watch out below, in my opinion, because they're very crowded trades.
Yep. Okay, well, a couple things very quickly. First of all, anytime there's a new theme that's really, really hyped up, it's usually overhyped. And that doesn't mean that it doesn't exist. It doesn't mean that it's not going to be meaningful, but there usually is an overbought position on that theme before it settles back into price discovery just of the theme. And then you have to figure out beyond that which companies are going to actually win along that range. They don't all win, right? So I think that's probably where we are with some of this healthcare stuff. The other thing I would say is, as somebody who talks about small caps all the time, it's been a long time since we've had pharma be synonymous with growth, right? But in the small cap space, pharma is pretty growthy. Pharma and biotech are big elements of small cap ETFs, particularly small cap growth ETFs. We don't talk about it a lot in the large cap space because a lot of times in large cap, we're talking about healthcare as defensive. But this is a period where you've got some new developments in pharma/biotech where large cap companies are getting some of that growth bid. And I think that this is an interesting way to play some beta in the market in healthcare as a sector because it's not as rate sensitive. It's not thrown in the bucket with tech and communications and discretionary from a growth perspective, but it is producing some growth. So I think this is a good alternative if you're looking for growth opportunity. But as you've mentioned, as you've pointed out, I would be careful today because I think some of this has gotten overhyped. So let some of the steam come out. If there's any theme from this earnings season, it's that beats have not gotten rewarded as handsomely as they have in prior quarters across the board. So even if there are good results reported, I wouldn't expect it to be something that's astronomically higher in the stock price. I think we've also transitioned to a place in earnings where we've got the bar is a little bit higher rather than the bar is low and we're jumping over it easily. The bar is higher because we have high expectations for next quarter and beyond. So the stock prices aren't getting rewarded as easily.
Yeah, no, and I could see a Lilly or Novo trading the way, let's say, Alphabet did, where the quarter wasn't that bad, the guidance wasn't that bad, but investors just kind of hit the sell button first and want to ask questions later because it's a very crowded trade and you have that sort of price action. All right, Liz Young, really appreciate all of your commentary this week. Everyone stick around. Guy and Danny had a great conversation with Brent Belote. He is the founder and CIO of Kaler Capital on all things crude and energy.